Well, I think what's happening is that there are different people playing in the markets at any given time. Most of the time, when it's about Fed decisions, it's about the short-term traders, and therefore the moves tend to be how they were pre-positioned. So if they get a positive surprise, you get a bounce, and vice versa. But I think what's going on at the moment is that there's a lot of long-term investors started putting money back into the bond markets back in October, and now it's the asset allocators who are thinking, what am I going to do next year? Because I think the key message that comes out of this is that the one asset class that you've been hugging all year, which is cash, is the one that's not going to give you a capital gain next year. So instead of saying, I'm just going to hold on to cash because I don't know what's going on, they're going to say, how can I beat cash? So I think what's happening now is that the markets are positioning, expecting that big asset allocation move out of cash into various parts of the equity market. And that's now going to be the tricky bit. Because, of course, one of the reasons that inflation is slowing and the Fed are not going to keep raising rates is because the economy is slowing. So there's two sides of this. Yes, they're not going to keep beating it to death with higher rates, but on the other hand, it does require some nuance to actually work out how and where you're going to be putting your money. And that's going to be what the markets are going to try and do for the next few weeks, I think.
So while we've been enjoying these really high yields, cash has been king, hasn't it? And if cash is not good enough now, the question becomes, how do you invest your money? And I see here that you're looking at things in a really interesting perspective, that 2024 is a year for farming and not hunting. Can you explain that?
Yeah, well, I quite like that analogy because it does return us back to the idea of investing rather than just trading. And everybody's been feeding themselves with this wonderful diet of game that's been driven across in front of our gun sights, so to speak, for the last 10 years by super low interest rates. And it's been very easy to sort of capture alpha here and there. And we talk like we're hunters. We talk about opportunities and grabbing things. Everything's done on a daily or a weekly basis. Now, without that low interest rate driving the prey, if you like, across, how are we going to feed ourselves? We've got to go back to the sort of older style of, okay, we've got to do some farming now. We've got to compound growth over time. This isn't about using leverage to take a small arbitrage and manufacture a huge return out of it and maybe gain from no liquidity or gain from huge amounts of leverage. So it's going back to investing now. And I think that is what's going to happen is the long-term investor is going to say, okay, where's the cash flow? Where's the balance sheet? Who's actually doing well out of normalized interest rates as opposed to ultra-low interest rates? I want to just participate in sort of preparing long-term returns. And as farmers, you can't blame us for the weather, but you do need to know what to do when the weather is in your favor. So I think there's a lot of planning now as opposed to opportunistic, oh, there's an arbitrage, I can grab that, throw 5 times leverage at it, make a return, then do another one the next day. I think the whole landscape is changing. And we kind of knew that coming out of COVID, but I think we spent the last year just holding on to cash. But I think for 2024, if you're an allocator, you can't say, if you're saying to your client, oh, I can't beat cash, then your client's going to say, well, why do I need you? So it's really forcing people into how are you going to generate long-term compound returns? And you can't do it just by using leverage and illiquidity anymore. That was the game for the last 15 years, no longer. So that's why I describe it as hunting versus farming.